Welcome to an exhilarating exploration into the world of finance. Today, we're diving headfirst into the riveting relationship between U.S. Treasury yields and inflation. Now, let's get to the heart of the matter. U.S. Treasury yields and inflation share a fascinating connection. Just imagine a scale. On one side, we have the returns from rolling over short-term Treasury bills, and on the other, we have the returns from buying long-term Treasury bonds. Here's some food for thought. Historically, the total dollar excess returns from long-term bonds have never been negative for maturities of 10, 20, and 30 years. Quite a revelation, isn't it? But wait, there's more to this story. Shorter maturities, however, show a less positive trend, primarily due to recent rate rises. It's like a seesaw, with short-term and long-term yields constantly balancing each other out. So, as we journey further into this intriguing world, we'll see how these trends and shifts in the Treasury yields can impact inflation. Stay tuned as we delve deeper into the intriguing world of Treasury yields and their impact on inflation. Now that we've set the stage, let's journey through the evolution of returns and term premiums. As we delve into this historical narrative, it's fascinating to observe the performance of Treasury bonds. Long-term bonds with maturities of 10, 20, and even 30 years have consistently presented positive dollar excess returns. This resilience is testament to their reliability as an investment instrument, especially in times of economic uncertainty. However, the pendulum swings a bit differently for short-term maturities. Despite the recent hike in rates, these bonds have still managed to yield returns that lean towards the positive side. This might seem paradoxical at first glance, considering the inverse relationship between bond prices and interest rates. But it's not as simple as it appears. You see, when interest rates rise, bond prices typically fall. Yet the prospect of higher yields in the future can counterbalance this initial price drop. This is particularly true for shorter maturity bonds, which can be rolled over more frequently, capturing these higher yields sooner. Now let's shift our focus to term premiums. For those new to the term, it's essentially the extra return that investors demand to hold a long-term bond instead of a series of short-term bonds. Historically, this premium has been positive. It's an additional reward for investors taking on the risks associated with long-term investments. But remember, the financial market is a dynamic beast, constantly evolving and adapting. Even though we've seen positive excess returns and term premiums in the past, it doesn't guarantee the same for the future. Market conditions, economic indicators, and investor sentiment all play a role in shaping these outcomes. As we navigate through the currents of the financial market, we uncover the nuanced dynamics of Treasury yields. As we sail further, we encounter rough waters. The market is in turmoil, rocked by the waves of inflation concerns. A tempest of uncertainty has swept across the U.S. stock market, with fears of sustained high inflation causing significant declines. The Dow, a barometer of market health, plummeted, diving 600 points at its lowest point. And what's the wind driving this storm? The rising 10-year Treasury bond yield. But the weather didn't shift on its own. Remarks from Federal Reserve Chairman Jerome Powell stirred the seas. Powell highlighted that inflation is not just a passing squall, but an elevated and persistent phenomenon. In the coming months, he foresees these high inflation levels continuing to buffet the market before a potential moderation. This forecast has economists and investors battening down the hatches. They believe that the Federal Reserve, in response to the rising inflation, will soon reduce its monetary stimulus program. This change in course could lead to further market volatility, as the safety net of stimulus is reeled in. And let's not forget the role of consumer confidence in this stormy scene. For the third consecutive month, consumer confidence has been on the decline, adding another layer of complexity to the market's current predicament. In this climate of uncertainty, it's no surprise that the market is feeling the effects. But it's not just the financial weather we need to monitor. The socio-economic climate, the policy decisions, the global events, they all contribute to the ebb and flow of the market. Inflation, a storm that's causing ripples in the market, is something we need to keep an eye on. As we navigate these turbulent waters, understanding the elements at play is crucial. It's not just about weathering the storm, but learning how to sail in it. The market might be in turmoil, but remember, chaos often breeds life when order breeds habit. We've come a long way on this financial voyage. Now let's gaze into the crystal ball and ponder the future of Treasury yields and inflation. The correlation between these two factors has always been complex and intriguing. Historically, the total dollar excess returns from long-term bonds have never been negative for maturities of 10, 20, and 30 years. But recent rate rises have made the future less certain, particularly for shorter maturities. As we sail forward, some experts predict that inflation will remain elevated in the coming months before moderating. This has led many to believe that the Federal Reserve might reduce its monetary stimulus program soon. And what does this mean for Treasury yields? Well, they could rise, driven by concerns of sustained high inflation. But remember, these are predictions, not certainties. So what's the takeaway here? Stay informed. Keep a keen eye on the market conditions and expert forecasts. Make sure your financial decisions are sound and well-informed. Remember, in the world of finance, knowledge is your compass and prudence your anchor. As we dock at the end of our journey, we hope this deep dive into U.S. Treasury yields and inflation has been enlightening. We've navigated through the intricate relationship between the Treasury yields and inflation, observed the market's past turbulence, and forecasted its future. Your thoughts, questions, and insights are what keep this conversation going. So, comment below and let's uncover more truths together. Don't forget to subscribe for more insightful finance content. Until next time, keep exploring, keep learning, keep